Hey traders, Raghee here, and in this free recap video we're going to go over some of the energy markets. And this is where there is a good degree of some price movement that I believe can obviously still be affected by the equities weakness, but there is a narrative all its own and an uptrend that's still intact. We're going to dive into both natural gas and crude oil in this update. Now, there are trends that are still intact on the daily time frames of both these energies contracts. In fact, what we're doing now is something that I call pressing validity. And what that means is every trade has a validity. Every trade setup has a point at which we know we want to buy and we know we want the stop loss to be at. And so really you could kind of divide that to these two zones right here. And so once I know what I know in terms of validity is, right? It's my job as a trader to find those important levels that tell me this is where to buy, and this is where that buy would no longer be a valid position to hold. And I've said a lot right there. It's a very important concept. Notice I didn't talk about where we've lost too much money or too many points moved or the time of day or some economic report. I simply said we have to know where that buy would no longer be a position that we're allowed to hold. Well, that's all very much predicated on the kind of tools that we use. And these two lines right here, the top line of the wave, which is the 34 period exponential moving average, the 34 EMA on the high, and then that's this right here. And then down here, I have the 34 EMA on the low. So that's this lower line. Well, if I get in here, if we fall below this level, again, because I'm looking for dynamic support on the way up, when the grab candles are green, I'm looking for this zone right in here to hold. And if it doesn't, I want to get out. And you see that's worked in the past when the trend started heading up. So today, on the crude oil inventories release, both for natural gas and for crude oil, we projected a low. We took a look at the typical price movement range for these markets and calculated, hey, where would the low be? And is there an opportunity to buy that low because it's exhaustive? So on natural gas, that point at which we say, hey, you know what? This trade could be a buy as soon as this level, right in here. We actually had projected a low that put us down in this level based upon the price movement range. And the validity, just like the crude oil market I just showed you, is the opposite side. So just like in previous pullbacks, when the market comes to close the wave, touches the wave, etc., these entries right here, right here, right here, they're valid as long as we stay above the 34 EMA on the low, and it's no different here. Now that's what we call the POV stop. There are other types of stop losses we can deploy. Another one I call is a CISL, a cheated in stop loss. A cheated in stop loss. And that just means we've got a stop a little bit closer than the validity. But if you can take the validity of the trade, if you can allow that much risk or even this much risk, whatever it may be, whatever you can handle, okay? And that's a big part of the exits first mentality, the exits first mindset. If you can get in here and you can hold the trade to this level, great. All that is allowable risk. But if that's too great a risk, you look for another level where the risk would be less and you can handle that smaller risk to the stop loss. In fact, we go so far as to say it's the stop loss that should determine where your entry is, because it's that stop loss that will determine how much your risk is, not how much your reward is, but how much your risk. And you decide what is affordable. That's something that isn't talked about enough amongst the trading group. What can you afford to lose? Now, that zone cannot be arbitrary. It's going to be predicated on where the trade is no longer valid or the POV, but you decide which layer in that zone works for your risk tolerance. Okay, some traders are fine with the top end, some in the middle, some have to be absolutely at the bottom. That's the kind of discerning nature you need when you're looking for your entries. And again, think about, can I afford this trade if I get stopped out? Doesn't mean you can't take the trade. It just means you'll wait for in this case, a deeper correction. And both the natural gas and crude oil trades are pushing what we call the validity of their respective setups on their respective time frames. Daily for crude, 480 for natural gas. So think about that exits first mindset. And also, look, everyone's going to be talking about the stock markets. There are a lot of trades that are going on out there that are not as sensitive or as hyper volatile as the equities markets or even markets like gold are right now. I know most traders want to beeline for those kind of markets, but what I'm trying to tell you is there are setups that are working very nicely in other markets that aren't the Dow, the S&P, the NASDAQ, the Russell, or even gold. Volatility doesn't always mean opportunity. Oftentimes it means risk. And right now, within the stage of transition, I really implore everybody to exercise a little bit of patience and realize that a trading career is a long and wonderful thing unless you feel that these kinds of days are days that you must trade. You don't have to. It's okay to wait to see what kind of range gets put in. And then after that, get an idea of what kind of volatility is moving the market. And then give it a day, 2, 3, maybe 4, and then realize there's 20 trading days a month and 12 months a year. There would be plenty of time for great trading to come. In the meanwhile, I think it makes sense to be looking at market structure in a much more significant way. We're going to talk about the importance of market structure and how to recognize it in the premium video. I will see you in the next update.